Structured investments. Have you heard about them? Maybe. Do you know what they are? Maybe. Want to find out for sure? Well, stick around for this episode of UBS Trending. I'll be right here. Hello again, everybody. Thank you for joining us for another episode of UBS Trending. I'm Anthony Pastore, your host, and I'm here with Dan Scansaroli from the Chief Investment Office. He is the head of portfolio strategy in UBS Wealthway Solutions. Dan, great to have you here. I want to get right into it. I mentioned right in the intro, structured investments, which is a financial instrument that maybe some people have heard of. Maybe they even have it in their own portfolios, but maybe some people out there saying, never heard of that, have no idea what it is. So for them, what is a structured investment?
Well, a structured investment is a type of investment vehicle that is linked to an underlying security. Security could be an index, it could be a stock, it could be a commodity, it could be a bond, it could be also a currency. It can be basically linked to any traditional product that's out there. Mm-hmm. And what it does is it actually transforms that underlying index return or risks into a different return profile for an investor so they can calibrate it to different market environments or even manage risks in the process. And there's three basic types of structured products that are out there. There are some that transform it into yield. There are others that enhance return, also usually referred to as a gear, where you get additional upside potential. And often with these contracts, there is also downside protection or buffers that are put on to mitigate risks. In general, to think about an analogy, you can take a whole bunch of different types of ingredients. Those ingredients are different options contracts that are being prepackaged together to mix together to create many different types of foods that are going to deliver different flavors for your portfolio.
Right, it's like making a really good soup on a weekend with the ingredients you have in your fridge.
Exactly.
Something like that, right? With a chicken stock base. I'm getting hungry just thinking about it. But it's sort of, the way you're describing it, clearly it makes sense, but for some people it might sound like listening to like a college level course. So let's kind of break it down a little bit. We know that there's some trepidation out there for investors about the markets because we're expecting some volatility over the next couple of months. We're still kind of wondering hard landings or soft landings. Where will equity markets go? So, and maybe they're hesitant to put their cash to work right now. Can structured investments or structured products mitigate some of that risk for investors who are maybe worried about that?
Yes. So structured investments, once again, these are a contract that has a defined expiry, and you can use them to mitigate those downside risks if you're, depending on the market environment which you're looking at. And as you pointed out, in the current environment, we have a view that markets are generally going to be flat. Mm-hmm. We're going to see higher volatility. And so in that environment, well, how can we generate attractive returns but also mitigate those downside risks? So let me focus a little bit on those downside risks. One feature in structured notes, and don't be scared by the name, all these structured notes have different complicated names, but one of these notes is called a trigger auto-callable note, or a TAN by short.
I like the acronym better. It's probably easier to remember, right?
Exactly. And one feature of those notes is that there is a downside buffer. And so typically they'll say, for instance, the underlying index that we're measuring this contract against is the S&P 500. And if the S&P 500 is down less than 25% on a particular valuation day, then you'll have full capital protection up to that point where you will get your capital that you already put in this contract back, the entire principal allowance. And so on the other side of that, there's obviously the risk, which is, well, what happens if you're below that 25%?
Right.
On one of those evaluation dates? Well, in that scenario, unfortunately, you're going to be delivered the market performance. Now, the key here is around the time horizon in terms of the evaluation periods. Many of these TAN notes, they can be structured with a 5-year investment period, which means that they're not evaluated until the end of the 5 years. And the probability that you're below 25% from now until 5 years from now is very low. It's happened less than 5% of the time. The longer the investment period, the less risk that you're taking that you're going to breach that downside, and you're going to get that protection.
Right. Historically speaking, right? Obviously,
Yes.
everything comes with risks, but historically speaking, just looking at data, it's a good option for a longer time horizon. So Dan, okay, so you described the scenario where you see the markets going higher over that, for example, 5-year period. But what about a flat market? Is it a good idea to think about structured investments in a flat market environment?
Yeah, there's different flavors of structured investments, and looking at that 5-year trigger auto-callable note that I mentioned, that is ideal for a flat market. And why is that? I didn't talk about the other side of it. We have that downside buffer. But in the environment that we're in right now, we don't believe that over the next year markets are going to go significantly higher. In fact, there's going to be more volatility, with valuations sitting where they are. The prospect for returns over a 5-year period, when you see multiples around 20% on the S&P, well, the typical return in that environment is somewhere around 4%.
Right.
Right? Now, that's pretty flat, especially over the next year. And so as we look at that, these TANs, what they can be used to do is on the upside, the way they're structured is that you get an 8% return a year from now if the market is up. It's going to be auto-called. That's why it said it had that call feature, right? So if the market is up a year from now, you're going to get 8%, and you're going to get the contract is over. It's all done. You got your capital back.
It's like a 1-year contract, even if we're flattish, maybe
That's right.
slightly to the upside, 8%.
You got 8%. Now, what if the market is down a year from now?
Right, of course. There's always the risk.
This is actually even a better scenario for this note.
Okay.
Because what it transforms into is it says, hold on, we're going to keep your capital invested in the contract, and we're going to wait. And on the next quarter, we're going to see, is the market up again? And if it's not, we're going to check to the next quarter, all the way until we get to that 5 years. And the longer time that the market isn't up, the longer you're going to accrue 8% annualized. So when you go to 2 years, you're going to have more than 16% returns. When you get to 3 years, you're going to get another 8 on top of that. And it's going to continue to accumulate until markets are up on that observation date, those quarterly observation days. So if you believe that markets are going to be flat, well, if we do believe it's going to be flat, the great scenario here is, well, we're going to get at least an 8% return as long as markets aren't down more than 25%.
Right.
As
you described previously.
As I done before. But
right.
if they are down, it's going to keep, but less than 25%, it's going to keep rolling and rolling until the end of the contract. Now, you need to make sure that this is going to actually be up at some point, which is also why we want a long contract, because that's when you get paid, right? But on the other side of this, the odds that this thing is going to be called within a year are they're above 80%, right? So, if you think about flat markets versus an 8% plus return, depending on the contract that you end up getting, that seems like a pretty good trade-off to transform a flat market into a different risk profile.
Right, so obviously there's no such thing as a guarantee in this business, but it sounds like there's more opportunity to make gains even in a flat market environment, as you just described, and there's no hard and fast expiration date. They keep rolling it over every quarter until they can start to see those gains come in.
It expires in the 5 years, whatever the term of the contract is.
Within that period.
It keeps going until it's called, because what triggers it is the market being above your initial value.
Yeah, it's fascinating. It's really, really interesting, and I'm glad we're talking about this today. Clearly, it's a priority now because you don't expect very much gain in markets or stock markets over the next year, given the environment that we're coming from, where we saw tremendous gains in S&P 500 index.
Absolutely.
Yeah. So Dan, let me ask you, of course there's risks to everything. I mentioned that before. What factors should investors be? Obviously they need to work with a financial advisor here, right? But what should they take into consideration before thinking about putting a structured note inside of their portfolio?
Well, each structured note has a unique set of terms. It's a complex investment structure that's using those derivative contracts to create a specific profile. So first, understanding what your views are in the market environment, how that structure can align with that. And there's different risks that it comes with. You can customize that downside buffer. You can customize how often it's evaluated. You can customize how long that contract is going to last. And all of that changes the risks in which you're taking. But on top of that, some unique risks to structured products is the fact that you are buying a contract for a duration of time. So you're trading off liquidity. There is a secondary market for it, but generally you should think of these investments as you're going to invest and you're going to hold it until it gets called or until it matures.
Right.
And then the last part of this is there's what we refer to as counterparty risk. The banks that are packaging these structured products, that are designing and building them, they are the ones who are guaranteeing the payout structure. Now, they have the capital and they have the structures in the option market to back it up, but at the same time, you're taking that counterparty risk of the issuer. And so you want to make sure that the bank that is on the other side of it has a good credit rating.
Right. Obviously, very important details to know, and that will come from the particular investor's financial advisor who will have all the detailed information. Dan, I know this was not an easy one to get through today because explaining this, it is like taking a college level course in the span of 10 minutes. So really appreciate you coming by and talking about this topic with us and giving our audience something to think about as they go think about their next contact with their financial advisor. Thanks,
Absolutely.
Dan. Yeah.
Absolutely. As you think about this, it may be complex, but it does add an element of diversification and opportunities to generate differentiated returns for your portfolio.
Perfect, perfect. Yeah, and everybody watching, obviously you're not going to walk in and explain a structured investment to your advisor, but just tell them you heard it here on UBS Trending with Dan Scanzaroli, and they'll take it from there. So Dan, thank you again. And for more information on this topic and any others, visit our website at ubs.com/views, and you can also follow us on various social media platforms, including our fairly new Instagram channel at UBS Trending. Lots of content that you're not going to find anywhere else. And as always, remember, please speak with your financial advisor about this topic or any others that we talk about here on the show. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. See you soon.